The Money Show. Personal finance.
And so, Warren Ingram this evening on The Money Show. It's good to have you with us, Warren Ingram. I believe that you've had some excitement recently.
Yeah, thank you. I'm very glad to be on the show.
I'm very glad that you are here. It looks expensive.
Yeah. Well, I can tell you, don't have a head-on collision with a taxi. It never ends well for anybody.
Okay, but you came out of it okay. I hope everybody in the taxi was okay.
Yeah, I'm waiting for feedback. I think five people were taken away in an ambulance, so it wasn't good.
Okay, but you're okay. You're with us.
I'm alive and I'm here and I'm ready to go.
Okay. I'm glad you're here. Glad you're here. Now, got an email from Mark, and he would have been disappointed if you weren't here. Here is the email from Mark. He says, I use my tax-free investment allowance for my more risky investments in the hope that one day I get it right and will avoid the capital gains tax. My RA is much more conservative. You're keeping up so far, Warren.
Thank you.
You've had a bump to the head. I'm just making sure. In February and March, I invested a total of 62,000 Rand in a mining and resources fund, tax-free, with a reputable institution. And he names the institution, and it is reputable.
Agreed.
Since March, resources completely collapsed again instead of continuing in what I thought was the start of a recovery. So my 62,000 Rand is now 50,000 Rand. Normally, I'd wait it out rather than panic and realize the loss. However, now there is the new mining charter in the mix. Is it time to cut my losses? Now, I realize, says Mark in Cape Town, that there's no definitive answer, but we'll be very interested to hear your take and Warren's take on what one might do in this situation. Cheers, Mark in Cape Town. Interesting, great, timeous question on a whole bunch of fronts there, Warren.
Jeepers. I mean, it's just, you're right. And I think there are a few principles that we can use to guide us in making the decisions. And then I think there are a few pieces of common sense which we can try to apply, and then ultimately there's going to be I guess a judgment and a judgment call with some preference built in. So layers upon layers here, not just because I had a bang to the head. And I think the first thing is just so the principle of buying an investment and immediately after that it starts to go down. That's I guess happens quite a lot, probably more than half the time to most investors. So from a purely principle point of view, I wouldn't be changing my course of action if you've done your research and to look at Mark's point. The resources cycle had started to recover, through last year already. We could see that in the prices of quite a few of the commodities, and then also quite a few of the mining houses. And so I think that that sort of a trend, is not an incorrect one to consider. And I think it's important to note that, like any big trend, it doesn't just move in one straight line, either up or down. And so if there is a recovery in the resources sector, it might well, happen almost in a stepped approach. So it'll recover for a while, take a breather, might go back a bit, and then kick in again and carry on. And so when you're making a decision like this to say, well, I thought this recovery had started and now it's over. I'm not convinced that that's necessarily the case. And I'm not really the biggest fan of the commodities in general, Bruce. So for me, looking at something like this, I'm saying, well, I think that call on its own is probably too early to make. The complicating factor in this is then I almost want to say the relative insanity of the new mining charter. That just if it stays in its current form, many brighter people than me have expressed their opinions on the damage it's going to do to the sector, and so that's an interesting one. But I think what you've got to do when you look at a decision like this is you also have to understand now that there's an element of speculation involved in what's going to happen, because a lot of commentators will tell us that this law just simply won't pass muster. This charter won't pass muster. The legal challenges are very strong, etc., etc. And so, selling out now and cutting your losses right now might be precisely the wrong thing to do if this charter actually does get turned around. And then, we find a more rational and kind of business-orientated compromise rather than what appears to be, benefiting a few rather than the country as a whole. So to me, I think you've got to be very careful when you make two different sets of decisions here. One on the cycle itself, because to me, you've got to go and look at things like what's going on in the Indian economy and what's going on in the Chinese economy and the broader emerging markets, because I think that's
far more important from an investment in a unit trust or in a fund, in a mining and resources fund, than what is happening in South Africa right now. As uncomfortable as that is, you've got to trust that the mining and resources fund manager, the person who is looking after this fund, is aware of the risks inherent in the environments in which they are operating. Because had this investment gone from 62,000 and say it was sitting at 50,000 rand this morning at breakfast time, you would have missed out on a 5% gain today. And that is the great risk of investing emotionally and drawing money emotionally rather than taking a big step back. And maybe having a bit of Nikki Webekicha's rum that she was talking about. Not too much, though, because that could make you throw more money after bad. But just to pause for a moment and say, what is the real state of play? Here we've got an unworkable, dangerous, potentially devastating mining charter, which is being fought in the courts, and the courts are going to uphold the law. They've shown their tendency towards that. And on the other side, we've got this is a mining and resources fund. This is a big universe of potential investment around the world. This isn't just buying a South African gold company, for example, or anything else.
Exactly, and I think that's a great point, is to separate the two. So most likely that the fund will have a limit of about 25% that it can invest overseas, and there might well because it is a mining and resources fund, which means that I can't remember off the top of my head how much it can allocate, for example, to pure resources. In other words, to buying physical, the physical commodities as opposed to the actual mining houses or mining companies themselves. So if that long-term recovery in the resources sector is carrying on, then, 25% would be exposed to international markets, and then an additional whatever significant percentage could be just in resources themselves. And that would have zero, there would be no impact on resources, the prices of commodities by the mining charter, because those are dictated globally and then priced here again in rands. So I think there are too many drivers of a portfolio like that will be pushed from the big international markets and the big international economies to take such a narrow view just on the mining charter.
And ironically, there's almost a protection built in to something like the resources sector, because let's say, for example, the charter is implemented and resources companies are forced to oblige. We see zero investment, and we are seeing very little investment into exploration and into development of new mining, and therefore one of our key exports falls off a cliff, and we're not exporting the minerals we once were. That is negative for the rand. You've got that protection built into this particular investment, because if the rand loses value, the investments that you have outside of the country by virtue of this fund, and in there you could have some Billiton, you could have some Sasol, which has got big American exposure, you could have some Glencore, which has got very little South African exposure, and you've got Anglos, of course, which the smaller percentage of its exposure is South African. I mean, this is global exposure with South African assets anyway. So if the rand does lose value as a result of bad politics, there is a buffer built in there as well. Or am I scratching desperately for upsides?
No, I think it's an absolutely valid comment, and it's almost that rand hedge component is very similar to just looking at the entire JSE. That rand hedge buffer is built into our biggest companies listed on the stock exchange anyway, and as you say, very specifically then to the resources sector. So I think that it's a great point, and again, to me, if I'm looking at this, my first view would be to try and get an understanding of what's going on in those big emerging market economies outside of South Africa first, and then just get a feel for what that overall trend is, and then apply that to what's going on with the mining charter, and then make a decision. So to me, I'm always I'm very slow to buy into any investment once I've done my homework, but I'll make that decision. But I'm even more slow to sell. Because very often you might find that you just needed to be slightly patient for slightly longer, and it's amazing how you would have been rewarded. So I think the comment, though, just to jump on the other side of this fence, as one sports commentator said, on the other hand. So on the other hand of this is, I know Mark does mention that he's got an RA that's much more conservative.
And now I want to pick up on that point as well, because that's an important point to make. If you want to ask Warren Ingram any questions on this or anything else to do with money, personal finance, please give us a shout. Warren can have a loan, please, because he's not like that. He's not that kind of guy. He's not a bank. Warren Ingram is a financial advisor at Galileo Capital. This is the point I wanted to ask you about. And here's Mark in Cape Town saying, I've got a tax-free investment allowance for my more risky investments in the hope that one day I get it right and will get the benefit of the upside of the more risky investments plus avoiding the capital gains, which is manna from heaven. His retirement annuity is much more conservative. I quite like that as a strategy. But you're the financial advisor and you're going to tell me he's mad.
It depends on his age. So to me, when he says more conservative, if he says more conservative, but that means that he's got 65 or 75% of his assets in the RAR are invested in shares in one form or another, and the balance spread between cash, bonds, and property, that's great. But if he's saying that he's only got 25 or 35% in shares, then and he's got quite some time to go to retirement, then I'm going to question that one as well, because I think the exposure to shares is important to give you that growth above inflation, and so that's really the thing that was bugging me slightly looking at that comment. In contrast to that, just to say, if that RA, let's say, is worth R1 million, and then you look at his exposure to the resources in his tax-free, and that's at 50,000 now. That's also an important comment to make, because I think it is kind of risky having a very narrow sector bet, or bet is the wrong word, but view on an investment. So my comment would have been looking at that resources fund. If it's 5 or 10% of your investment base, then taking a very specific view is great. I don't have an issue with that, and let it ride in one direction or the other for time to let your view unfold. But if his RA is worth 50,000 or 60,000 and his tax-free is worth 50,000, and that means half of his asset base is just in one sector, that's concerning to me. And then I'd swing all the way back to what we've just discussed and throw that out the window, because I think he's then over-invested in something that's just simply too aggressive, too risky for what would be half of his investment base.
Warren Ingram from Galileo Capital is my guest this evening. You know him well as Mr. Personal Finance. Any questions for Warren tonight? 021 446 0567 011 883 0702. We're chatting about investments. We're talking particularly about when to panic and when not to panic, and also how much risk to take when it comes to making investments. Absolutely pivotal decisions for anybody who's buying unit trusts. Whether you might very well have your company pension fund, and you think, I'll just top it up with a unit trust or a tax-free savings account, and then you might start playing a bit and taking a little bit too much risk and scaring Warren. I like to have a scared Warren, and let's do that this evening here on The Money Show.
The Money Show. Personal finance.
Warren Ingram from Galileo Capital. Let's expand Mark's email a little bit and make it a bit more broadly applicable, Warren, because as we're coming to the end of the second quarter, the year is halfway done, believe it or not. I can't believe it. And the market is lower today than it was at the beginning of the year, and it is certainly gone nowhere in the last 3 years. If anything, it's actually 10% below where it was at its peak, say 55,000. The market's at 51,000, 8% below its peak. And in real terms, South African investors have lost money if they've been index investors, to the tune of an average of 6% a year in terms of inflation. So the money that they had invested in the market 3 years ago is worth probably 20% less in real terms than it was 3 years ago. And that's not a great advert for buying shares, I'm afraid, Warren.
It's not, and I think the longer it carries on, the more it tests the patience of investors in general, and it starts to create this trend that we see regularly, where we get to a point called capitulation, where people eventually just give up on the prospect of the stock market ever delivering real growth, growth above inflation again, and they sell en masse. So you're right. It's not a great advert. Of course, I would be remiss to not show the other side of that argument. And what's interesting is when in the past, when the JSE has been through the type of no growth or especially against inflation losses that we're seeing now, you tend to see a return of about 6 or 7% per year above inflation for the subsequent 3 years.
You have to run that by me again. Sorry. When you've seen 3 years of declines, real declines, as we've seen, we get to a point of capitulation. But sensible investors make money because what happens?
Because what happens in the 3 years thereafter, and I'm not saying it happens in a straight line like bank interest or something, but the returns that you can expect are typically about 6 or 7% a year above inflation for the next 3 years. So if inflation's at 6, then you're saying somewhere on, let's say, 12, 13% a year for the next 3 years. And that's not it's not a forecast. It's not predicting that that's exactly what's going to happen this time. All it's saying is in the last 117 years where we've got history on the JSE, typically when you've had that kind of a time frame like we've seen in the last 3.5 years, then that's been the average returns thereafter. There have been times when the markets continue to go down a bit longer, and so you haven't received that return. And there have been other times when the market's recovered and you've delivered 20 or 30% above inflation.
No, but and that's that does happen, and those with capital at that point tend to make very, very decent returns indeed. Here's the problem with this, though, Warren. The market can go down for a lot longer than we think, and it's also impossible to time the market. So back to your tried and tested guidance, and that is don't ever stop making the contributions to your RA. Don't stop making contributions to your monthly unit trust or your monthly ETF subscription. Keep making it, because every month that the market goes down, you're buying more and more with the same amount of money. Your $500 may have bought you 100 units this time last year. Now it might be buying you 110. You're getting more bits of the market for the same amount of money.
Exactly. And two comments there. The one is the last time we saw dividend yields that we're seeing now from the banks was when a certain finger wagging president was in power in the 80s, P.W. Botha, and that's a long time ago. And from an investment point of view, if you want to talk about a scary environment to be an investor, that was, I would argue, still a more scary time than now.
Sure.
And if you look at the returns that investors received in the subsequent decades, forget about just a year or two thereafter, the patient investors were well rewarded. So I think we have to be careful again, like we said, about being too caught up just in the dynamics of right now. And I think if we learn from the great investors of the past, they really often will run into the burning building when everyone else is running out screaming. And sometimes it is just a burning building, and it's the right thing to do just to leave. And I'm not saying that. And
sometimes it's a dynamite factory.
Exactly.
Tell the difference.
But sometimes there are great bargains to be had, and I think that's the point. Is you've got to look at the index is a great place to go. I agree with that, but remember the index is just a collection of businesses, and there are fantastic businesses here that some of them are being priced to bust. And that's just not the case. They're going through a difficult time, but that means they're great opportunities, and you need to be rational and look through the noise and make a good call in this situation. Don't make just the emotional call.
Warren Ingram from Galileo Capital.